S Naren joins us now. Naren, fantastic to have you back. Thank you for joining us. Naren?
Good morning.
I know you got the market bottom right, and great. My compliments on that. When markets fell to 7,500, S Naren came on this very channel and said, "Look, I'm going to buy because the markets give me value." And your words were that it may fall more, but market had reached a value zone from 7,500 to 10,000 on the Nifty, and 25 to 100% for individual stocks. The comeback also has been very substantial. Do you think this kind of an comeback and these price levels are justified looking at the economy?
See, you can't look at the economy, you have to look at the Fed. I think what really happened was Fed put $4 trillion of money or $3 trillion of money in the markets. And there is a value to $3 trillion. So I think what happened between 7,500 and 10,000 was $3 trillion of Fed pumping in money in US economy and also guaranteeing or kind of saying that we will stand behind a lot of the debt in the US economy. So I would say that if you had looked at economic indicators, you would have missed the entire 7,500 to 10,000 rally. But if you had looked at the indicators that are there from the monetary policy side and said that you're looking at the kind of money that Fed was putting into the economy, you would have realized that there was so much money being pumped by the Fed that is what caused markets to rise. Along with that, I think particularly in many parts of Europe, and I would say mostly in Europe, because US I see cases coming in COVID-19. I think that the problems of COVID-19 in Europe seems to have abated. And I think the worst part of COVID-19 in Europe seems to be behind. And in US, at least in New York and some of the places, it does seems to be behind. So I think that is the second factor which has played a role. And I believe the combination of these two has created a bull market in all parts of the world because Fed is, after all, the world central bank. I don't think it is the central bank of one single country. And we have to owe this entire rally to the Fed rather than to the economy.
So Naren, if one makes a very logical assumption, the first logical assumption is that interest rates will remain low for long. Central bankers are likely to print more money. They will follow an approach of whatever it takes to stimulate the economy. So what is the end game of this liquidity infused market? Because there is liquidity and markets are going higher. I guess that's an easy argument. The difficult argument is that how does one invest and how does one figure out that this is the finishing line and this is the beginning line?
To be honest with you, I think no one knows because it's very easy to bring down interest rates and take it down to zero. And I think Indian Central Bank has been very careful in bringing down interest rates, primarily because of the fact that it's easy to bring down interest rates to zero, but once you've brought down interest rates to zero, how to take it up is something that the world is still thinking about. And that is the challenge at this point of time, because it's easy to bring down interest rates to zero and start the whole process of extreme accommodation. So how do you withdraw accommodation and how does that process work? That is an area where I think globally, a lot of countries are still struggling. So I think this whole process, and if in India, if we were to bring down interest rates to zero, how do you take it up? There is a lot of cushion which is available for USA because it is the world's reserve currency. And because it's the world's reserve currency, a lot of benefit accrues to USA because it is the world's reserve currency. So they can do a lot of things which other countries can't do. But having said that, I think there is no easy answer here. And I think from the point of view of an investor, what I believe is at 7,500, 8,000, you should be very, very positive on equities and you should actually be very aggressive on equities. At 10,000, you should go back and say we have to follow asset allocation techniques and you have have to look at the upside, downside risks and follow asset allocation techniques, because it is no longer as cheap as it was at 7,500, 8,000. And if you are going to say that I'm going to be all in, then it is not as safe as it was at 7,500, 8,000, because at that point of time, you had everything going for you in a very, very big way, because you had panic and you had valuations being cheap. Now you have valuations being fair because you have the top 5 stocks being costly and the rest of the market maybe being cheap. On the aggregate, it is maybe okay. And there is no panic. So I would say that today you have to follow asset allocation techniques. And if the market does get extended due to powerful Fed accommodation, at that point of time, you have to actually cut your allocation to equities, because finally at some point of time, and we have seen it all in 2013, we have seen it in 2018, there are times when US Fed will try to cut accommodation and reduce the amount of liquidity in the markets. It is not a one-way street, and at that point of time, you will have corrections in all parts of the world in equity markets, including India. And at that point of time, it is only asset allocation techniques which will help you. If you're going to say, I'm going to be all in on equities all the time, then you will have corrections affecting your portfolio, that like what happened in 2020, what happened in 2018 in small caps. And those kind of things will hurt you. And that is why asset allocation techniques has become our mainstay, because that's the only way to protect your capital relative to the market at all points of time.
Now, Naren, asset allocation cannot be changed that rapidly. March, there was need to increase asset allocation to equities. But in June, is it time now to reduce asset allocation to equities? Are you calling for booking profits out of equities and moving back into some other instrument? I mean, let's first clear that.
I think basically, if you look at it, if you look at categories that we run, for example, on a 25% rally in equities, clearly you have to reduce the amount of equity in our dynamic asset allocation funds. And that is something we would do. And there is no way we can afford to have the same equity allocation in our dynamic asset allocation funds that we would have in the end of March today. So that is obvious, and I think 25% rally is not small. I think a 25% rally is large. So I think that is why I think there is no scope but to have a core allocation and dynamic asset allocation fund, because no investor in India earned 25% in your Nifty in the last 4-5 years, but in the last 3 months you could have earned 25%. And that is the challenge at this point of time, that markets are going to remain volatile, because the reason for markets going up is not earnings. If you had done earnings calculation and you had spent the last 2 months trying to do earnings calculation for different companies, you couldn't have come up with this buy. If you are, on the other hand, if you had just focused on what the Fed was doing in the last 2 months, you would have realized that a bull market was coming. So the irony at this point of time is, if you're focused on looking at earnings, you can't come up with a bull market. But if you focus on monetary policy, you can come up with a bull market.
Okay. Naren, you bought telecom, and I'm assuming that that call must be, or that exposure of telecom must be one of your largest positions across schemes, across categories. Now that everybody in the town is excited about owning telecom stocks, and we've seen what's happened to Reliance Jio in terms of sovereign funds and private equity funds and individual investors, putting in money on a daily basis. Do you think telecom stocks today are pricing in too much of optimism? Because typically when you invest, you like to invest when there is only cynicism and no optimism. For telecom 2 years ago, there were only concerns, there was no optimism, but today there is no cynicism and only optimism. Is it time to log out of telecom?
See, there is a time to put in money, there is a time to take out money. The way we look at it is, when ARPU growth slows down in telecom, is the time to actually take out money from telecom. And you have to also look at it, there are sectors in the economy where you have had a 12-year down cycle. Take telecom, take power, take some of the metal sectors. You have had some 12-year down cycle. So, basically you can't have a 12-year down cycle and a 1-year up cycle. So that is also a challenge at this point of time, which we are looking at. Can you have a 12-year down cycle and a 1-year up cycle? On the other hand, you can have a 12-year consumer, you can have a 12-year up cycle and a 3-month down cycle. This is the challenge at this point of time. I'm a believer you are going to have you can't have a 12-year up cycle in consumer and have a 3-month down cycle, because after the 3-month down cycle, you're still trading in that sector at 60 to 70 times trailing PE. On the other hand, even today, the ARPU in telecom is just about $2.50 or $2 per month, which would be the lowest ARPU and it was ARPU maybe 10 years back. So I think there is scope for ARPU to go up in telecom. There is a scope for many of the sectors which got derated in the last 10, 12 years to actually re-rate for 2 years. And I believe that is how we look at it from a cyclical perspective based on my guru forward marks. That you're not going to have 12-year down cycles and 3-month up cycles. Logically, you should have at least 12-year down cycles and 2-year up cycles. And the quality cycle has played out for so long at this point of time that you can have a down cycle in quality for at least 2 to 3 years. And even today, when I tell people that when stocks are at 60, 70 PE, they are actually saying that you're paying for 60 years earnings. People say, no, that is 60 years earnings is okay, because those earnings will keep growing at 20%. And these are all sectors where in the last 2 quarters, they have not shown any growth. So that is the beauty of long up cycles, that people forget rationality. The beauty of long down cycles is people forget growth. So I think there is a challenge, and I think value can do well for quite some time, because we've seen a 12-year down cycle. So I was looking at it, there is a metal stock in India which has a 1 lakh crore market cap. On the 1 lakh crore sale, the market cap of that company is 30,000 crores. On the other hand, you have companies in the pipe industry and other things which have not even 5,000 crore sale, but they have a market cap of more than 10,000 crores. So this 1 lakh crore sale company is present all over the world and is a market leader in the world in some of the areas, but the market cap is just 30,000 crores. So you have all these kind of dichotomies at this point of time, because when you have a multi-decadal down cycle, what happens is people give up on that sector. That the cumulative investment in some of the sectors which have done well from various institutional investors are large. Like, for example, I was looking at March 31st shareholding pattern of mutual funds or FPIs. I was seeing that the cumulative holding of FPIs today in the metal sector is only 1%. Or some less than 1.5%, because over a period of time, people have given up on metals. It is not that you can do without steel, you can do without aluminium, you can do without copper, you can do without zinc. But the reality is people have given up because in the last 12 years, you have not made money. So I think these are all cycles which will finally play out. Telecom is possibly the only cycle which has at least played out in the last 1 year. There are many other cycles which have yet to play out. And the challenge is you have to hold the down cycle, and the down cycle keeps lasting. And that is the situation at this point of time. So I think there are a lot of up cycles left, and there are a lot of down cycles left. And that's how I look at it.
Naren, I was watching an interaction with Howard Marks. I read some of his last memos, then I looked at our old interviews with Howard Marks, and perhaps Howard Marks or Mr. Marks is making a case that typically in a market cycle, economy will drop, earnings will drop, bankruptcies will start, and this capital kicks in. That's how a normal cycle moves, Naren. But this is not a normal cycle, because the interest rates are zero. So bankruptcies may not be large, interest rates will not go up in a hurry. So looking at the markets, do you think one should now understand that what we've seen in terms of a cycle of bankruptcy and earnings drop and risk capital and consolidation coming back may actually not happen this time in a lot of sectors like metals, airlines, hotels, because there is so much of liquidity sloshing around that promoters would find a way how to avoid bankruptcies?
I don't think so. If I look at different sectors, I think even today the consolidation in various sectors continue to be happening. And I feel that the stronger companies are getting stronger in sectors and cycles are going to play out. I mean, there are sectors where the consolidation has already got completed. Like telecom is one such sector where I would say that the consolidation is already kind of completed in India. That at the most we have either 3 players or 2 players. Whereas in many of the other sectors, the consolidation is underway, and I would say that the consolidation exercise is happening at this point of time. And I think even if the interest rates are zero, I think consolidation will play out. It is just that what happens in a zero interest rate environment is difficult for us to understand. But in India, we still don't have zero interest rates. In fact, you have a situation today that single A credit risk, which is not bad, and these are all companies which have good equity prices. These are all companies which cannot raise money in the bond market today. And that is the way the bond market exists today. And I keep telling everyone in the system today that you can't have a country growing if you're going to have only 5 companies being able to raise money in the bond market. And you should actually create a bond market where at least 1,000 companies are able to raise money in the bond market. Instead, we have created a corporate bond market where only 5 companies can raise money in the bond market and 995 companies have to exit the bond market. And that is very bad for the country because those 995 companies have to also create employment, because it is very important that those 995 companies are able to raise money in the bond market, and many of them will be single A names. And it is very important for us, a country like India, to actually create employment, because we are in a situation where employment has to be created. And if you're going to have only 2 or 3 companies in each sector, employment growth will not be good. So it's very important, like what has happened in the IT industry, that you have multiple companies in the sector creating employment, because that is the best way in which India can grow. So we should create a very, very positive bond market. And it is very important that single A kind of names should become very tradable, just like small cap stocks, because that is the way you actually, and you have to give incentive for single A names to get traded in the debt market. Instead, we work very hard to make it as though single A names in debt market are unsafe, whereas small cap stocks of doubtful financials are good names. So I think there's a lot of work to be done there, that we have to create, in fact, lesser consolidation in many industries so that more jobs are created, margins are lower in all the industries, because then we gain as customers.
Okay. So Naren, if telecom was your contra bet, let's say a couple of years ago, can I say metal is your contra bet, and on a daily basis you're buying into metal stocks?
I think we have many contra bets, in a sense that we have metals as a contra bet, we have power as a contra bet. We had bet on pharma as a contra bet a few years back. That has also worked very well, quietly, in fact, in this entire COVID environment. So I would say that, over the next 1 year or 2 years, I think we have to look deeply into financials and come up with interesting contra bets in financials, because financials is going through a big down cycle at this point of time. So I would say we have to look for the right bets in financials, because there is a contra bet. I would say that capital goods has gone through again a 12-year down cycle, that we have to start looking at interesting contra bets on the capital goods side. I think barring some of the names which have done extremely well on the last 10, 12 years and are trading at 50, 60, 70 times trailing. And apparently the top 5 stocks in most of the countries are trading at absurd valuations across all the countries. And it is not only in India. I think barring the top 5 to 10 stocks in all the countries, I think the rest of the stocks in many of the names in India and in other countries, I think represent contrarian opportunities at this point of time. And I used to think it is only in India that the top 10 stocks look overvalued relative to the market. I recently read a report that across all the countries, in all the countries, the top 10 stocks are overvalued and the remaining stocks are cheap. So I think there are so many opportunities for all of us. And it is very important that the SIP movement, which has started in the last 3-4 years, during the time that the market is lower, like today, I'm hoping that the SIP monies will continue to come from all the investors, because we can use that money to buy interesting stocks which are cheap in this down cycle and then deliver very good returns in the up cycle, which will come in the next 3 to 5 years. And that's what I'm hoping at this point of time.
That brings me back to a very fundamental question, which is that how does one align with the new growth patch of the economy? Now, whether it is digital or telecom or medical or perhaps home delivery or online retail, that's one big opportunity, Naren, which is opening up. It is like saying in 2010-11, those who bought NBFC, they did not buy value, but they bought the entire NBFC space, which opened up as a big lender to the economy. As a fund manager, one side is you buy value, but other side is you need to identify also large pockets of exploding growth. Where are those pockets according to you?
See, in the current year, if you look at it, clearly see some of these pockets of exploding growth are pockets where there has been a lot of loss funding. And somewhere I feel that that loss funding will require capital from the markets. And at that point of time, they'll have to come at reasonable valuations to raise money. So that's something I'm hoping at this point of time it will happen in the next 2 to 3 years. Because many of these pockets of very high growth, they have happened with losses. So during the heydays, they were given valuations for top line, not valuations for bottom line. And when they were given valuations for top line, it was okay, but it may not be permanent that you will get valuations top line. So the day they start having to get valuation for bottom line and they have to come to equity markets and raise money from mutual funds, maybe we'll be able to raise money at very attractive prices for us, because the moment they have to start raising money at bottom line based valuation, we will find very interesting opportunities. And secondly, I think areas like telecom and pharma and IT and various other industries, I think there are opportunities which are continuing in the COVID environment. And frankly, if you ask me, one of the major areas which has kind of baffled me at this point of time is in the recent past, people have not invested in debt mutual funds, and the entire lower interest rate regime has benefited any investor who has stayed on with debt mutual funds. And if you looked at any of the funds from the ICICI stable, and I agree that past returns are not an indicator of future. What happens is when interest rates drop, there is an automatic benefit which accrues to any investor who has invested in many of the debt mutual funds, other than categories like overnight and liquid, because the repricing of the old interest rates happen, and that leads to returns. That's why past returns are not equal to future returns. And somewhere many of the retail investors did not choose to invest in many debt mutual funds, and there they have actually lost a lot of money, because in a lower interest rate regime, the best returns have outside.
I think we've lost Naren there, but I like to call him the Mr. Contrarian as always, in terms of what his approach is. Look, they bought telecom, and they bought telecom 2 years ago. 2 years ago, when Jio was the problem in the telecom sector, Naren went out and took a call saying that telecom is too valuable to get destroyed. And then before the COVID crisis also, telecom stocks, they started getting normalized. Now, like they always say in markets, that prices go up and down and reasons follow. And I think that's really been the story in telecom, that prices started moving higher before the COVID crisis. And now Bharti, which got hit because of disruption, Jio, price war, everything. I think Naren is back. Okay, Naren, I think we lost you there. So I'm going to summarize our today's interaction, Naren, with one simple analysis of yours, which is that you are of the view that March gave a great entry point to increase asset allocation to equities. But June is a great level to reduce your exposure to equities. Let me summarize it, and please correct me if I'm wrong, because I don't want to get this one wrong.
Actually, June is a time to my view is that June is a time to actually increase your allocation to asset allocation kind of category, because no longer is equity as cheap as it was in March. So that is the way I look at it, and I believe that the next 2 to 3 years is going to be driven by central banks, what they do. If central banks get their act right, you're going to have a volatile market with moderate returns. If the central banks get their act too bullish, you would have a very bullish market. But at that point of time, at some point of time, you have to trim equities. That is why going forward from here, it makes sense to follow an asset allocation route to investing, because no longer are markets dirt cheap. Outside value and special situations, the markets are no longer dirt cheap at this point of time that you can actually give a big buy call on equity the way you could have given in March. That is what I'm saying. And frankly, it is the central banks which is responsible for the current global equity markets, and that is something we should not forget with this rally from 7,500 to 10,000. And central banks have a vested interest in keeping markets higher. So it's difficult to give a bear call at this point of time, but it is clearer that one has to give a asset allocation kind of call. I think what got missed out when my video got disconnected is that debt mutual funds represent a great investment, because in a lower interest rate regime, they are the products that can actually deliver a good risk-adjusted experience for most investors. And interest rates going down, debt mutual funds outside the liquid and overnight category actually give a very good experience to investors. It is only that AAA products today are low yield to maturity products. So investors investing in AAA products don't get that higher return right now because of the low yield to maturities. But all other products in debt mutual funds represent very interesting investment opportunities.
All right, Naren, always appreciate your time. Stay safe, my friend. I always look forward to interactions. You know, you give me or you tell our viewers something very different every time when we interact. A couple of years ago, it was telecom. Today, I'm getting a sense that it's metals, which you're looking at in terms of a contra. I appreciate your time, Naren. Thank you for joining us.
Thank you.